The ability to do these sorts of new things that you can't do in the traditional financial system, I think it's really exciting.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Here we go. This is the Phil Bach Podcast, and joining me this week is Matt Hougan. Matt is the CIO of Bitwise Investments, the world's largest crypto index fund manager. Matt was previously the president and CEO of ETF.com, where he led educational efforts on behalf of the entire ETF industry. I could say that because I was there and saw firsthand. Bitwise, I got to wish, Matt, I got to wish you congratulations. Bitwise just closed a Series B raise with investors including Henry Kravis, Druckenmiller, Daniel Loeb, David McCormick, the CEO of Bridgewater, an incredible list of investors. So congratulations on the raise and welcome to the podcast, Matt.
Thank you, Phil. Great to be here. And we're very excited about the raise, very excited what we can do with that money to build the crypto space.
So there's something you wrote a few years ago that really stuck with me that I really loved. And that was the concept of the potato peeler. And I want to start there because when I think about the debate about Bitcoin, the debate tends to focus on price more than adoption. Right? The adoption of Bitcoin in a lot of people's view is people allocating to it in their portfolio, not using it as a payment source. That fact alone has given me and a lot of people in the finance industry, I think, some hesitancy about jumping in with both feet. But when we talk about DeFi, and that's what I want to talk about today, decentralized finance, DeFi is really a discussion about like starting with a blank canvas on top of all this technology that's been built and saying, all right, let's get rid of the NSCC, let's get rid of the DTC, let's get rid of the exchanges, let's get rid of the 81-year-old 1940 Act that amazingly is still governing all of our funds. Let's get rid of the user-unfriendly system of the banks and the T+2 settlements and on and on and on. Let's get rid of all that. Let's take the best of the crypto exchanges, of the technologies, and build on top of that where, the possibilities are truly endless. So that's fucking cool. And I want to bring it back to the potato peeler because I want to explore DeFi today in the context of staying power, in the context of how these technologies could be built to last. So on that note, what is your potato peeler idea?
Vis-a-vis crypto.
Well, we'll bring it back around.
Yeah. So, the potato peeler is a funny thing. It's a technology, if you want to think of it that way, that's been effective and consistent since it was developed. We're still using the same potato peeler I was using when I was a kid. It still looks the same. It still shapes the same. And the reason is it does its job perfectly. It doesn't need any bells and whistles. It's efficient at doing its job. And so I think it's often good to think about what is it in a technology that's simply fundamentally good, true, and permanent that will stay that way in the future. And that's a good way to think about what matters in crypto as well, is what is it about crypto that's fundamentally new, efficient, better, and effective, and that will be true in the next 20 years. I think it's a good way to frame it.
And I think there are things happening now in decentralized finance that will fit that are just simply more efficient. And there are things to be, worked out. And there are certainly, and we'll talk about some of the pitfalls and some of the things that have just happened just recently with Titan and more. But let's take it from the top. What is decentralized finance?
Well, I'm going to even go one step back and say, what is crypto? And one way to think about what is crypto is it's a technology, crypto and blockchain, that allows money to exist on the internet. Bitcoin is the first money that exists on the internet. That means you can do some very basic stuff like move $1 billion around the world and have it settle in 10 minutes. Okay, that's cool. Also psychologically sort of challenging, as you mentioned at the top. What is this new internet money that rained down from the sky and is now worth $1 trillion? It's not a movie that we've ever seen before. One way to conceptualize what DeFi is what can you do once money's native on the internet? Because once money's native on the internet, you can program it like you can program any traditional computer. And that means that any finance function that's just an if-then statement can be programmed in a DeFi application using crypto and blockchain and made exponentially faster, more efficient, more interesting, and open to more innovation, right? So a very simple example to get people's heads going around it is something like an escrow agent, right? An escrow agent just sits in the middle of a transaction, like when you buy a house, and waits for you to send them $1 million and someone to upload the title of the house, and then they cross that transaction. And we've been using trusted humans in that space for centuries. But it's really a very simple if-then statement. And if you have money that exists on the internet, you can program software to execute that transaction flawlessly at the fraction of a cost of a nice person who wears a nice suit and has an office. Once you enter that mental space of what financial activities really just amount to if-then statements that can be programmed in software and executed automatically with built-in trust, that's what DeFi is. And the exciting thing about that is, maybe the frightening thing to some people in the financial services industry, is that's a big chunk of what we do. And the beauty is it can get rid of many of the things you mentioned at the top, which are absolutely ridiculous. This is 2021. We're waiting 2 days for stocks to settle, Phil. It doesn't take 2 days for anything to happen in 2021. The financial system is the only place where we still measure things in days and not in seconds. And DeFi allows us to measure that in seconds or fractions of a second, allows us to make much of the ecosystem much more efficient, and it allows us to do things we've never done before, which is pretty exciting.
So it's a more efficient ecosystem, or at least, it will be at full maturity, but it is its whole ecosystem. There's a whole new language, a whole new set of moving pieces. What are those? What are the key pieces that people need to think about and understand?
Yeah, I think there are 2 layers. So there's layer 1, which is, you can think of as sort of the internet on which decentralized finance apps exist. So a good way to mentally model this in your head is there's the Apple iPhone store, and then there are apps like Uber that sit in the Apple iPhone store. Uber is a many $billion, hugely valuable company that we use day to day, but it really only exists on this infrastructure that's iOS and the Apple platform store. The same thing is true in crypto. You have platforms like Ethereum, which is sort of a global compute platform. And then you have apps that are built on top of Ethereum that run on Ethereum and that do fun things. So an example of that app in DeFi, Uniswap, which is the largest DeFi asset, a very simple way to think of Uniswap is it's like a decentralized version of Coinbase. Coinbase is a company, went public, $50 billion, allows you to trade one crypto asset for another, has hundreds of employees, used to have an office in San Francisco. Uniswap is a software program that allows you to trade one crypto asset for another, is doing $50 billion in volume a month, generating hundreds of millions of dollars in fees, but there is no centralized company. So I think thinking of that, sort of the app store and then the apps, Ethereum and other layer 1 blockchains, and then specific apps like Uniswap is a good place to start in thinking about how this ecosystem builds.
Okay, so Ethereum is the blockchain, right? And Ether trades on the blockchain. Ether is the currency or the coin, the value, right, that's transacted. But in order to interface Ether, right, and I may have this wrong, so help me out here, but in order to interface that with my dollars that I start with, I need a stablecoin. Is that where the stablecoins come in?
Stablecoins, yeah, they play a role in the ecosystem. You can trade US dollars for Ethereum and then use that Ethereum to power the Ethereum blockchain. Stablecoins are just a digital representation of the dollar, but they fit into this crypto ecosystem in a way that the dollar does not. So they can settle instantaneously. They can move anywhere very quickly. They're digitally native in that sense. So it's just a digital representation of the dollar. Some of them are well designed, well regulated, and well backed. Some of them are poorly designed, unregulated, and not well backed. But at the core idea, it's just how do you get like a physical greenback into the digital world? You do that through the digital dollar, and then you can spend it the way you would dollars in the traditional financial world.
Okay, so you manage the Bitwise DeFi Crypto Index Fund, and the 2 largest holdings are Avi and Uniswap. Now, Uniswap, if I think about it as a decentralized exchange, does the coin represent shares, like shares in a stock, shares of the exchange, or is that what's being used within the exchange? What exactly is the coin?
That's exactly the way to think of it, is akin to shares in a stock. So it has effectively the same role as shares in Coinbase. What it entitles you to is governance over the protocol. It's a governance token. And there's an expectation that at some point it will arrogate or take a portion of the fees that are generated by that platform. So the way Uniswap works, if you think of it as an exchange, it's decentralized in that anyone like you, Phil, could become a market maker on that exchange and set up an arrangement to provide liquidity to that exchange. And you would get paid a fee for providing that service. Eventually, the expectation is that the Uniswap token will get a portion of that fee. You as the market maker will get most of it, but the token may get 10 or 15%. And so people are buying the Uniswap token for the same reason they're buying Coinbase stock, because they want a call on those cash flows. Now, it happens to be sort of pre-revenue today, but there's a plan for it to go post-revenue and begin, irrigating and capturing those fees.
By far, the best thing about this space are the names of the tokens. They're fantastic, right? So, I'm looking down a list of the holdings, and you've got Sushi Swap, which is just fun to say. You've got a bunch that sound like Star Wars characters, UMA, Loopring, synthetics. How do I think about when I see a list of all these different coins that are held in your fund? To me, my first, being trained in traditional asset management, I'm like, well, these are kind of smaller cap, higher beta versions of the same thing, but they're not. They're all different. How do I think about the different components that we'll stick with the ones that you've invested in the DeFi crypto index fund?
Yeah. The same way you think about the holdings in a financials ETF. So if you look at a financials ETF, or it's not quite as clean because some financial services are integrated, but if you think about the financial services that are provided, there can be exchanges, there can be liquidity providers, there can be lending facilities, there can be asset managers, there can be insurance companies, et cetera. And the same thing is true in the DeFi space. So if you look at our largest holding, Uniswap, it's a decentralized exchange. The best way to think of it is a decentralized version of Coinbase. If you look at the second largest holding, Aave, it's an app that facilitates collateralized loans in crypto. So you can go there and post Bitcoin as collateral and take a loan in another crypto asset. And it's processing hundreds of millions of dollars of loans in that space. As you go down the chain, other assets are doing things like that look effectively like asset management. They're seeking out yields in an algorithmic fashion in the crypto space, or they're competing with another asset to do the same service. So for instance, there are a lot of assets that compete with Uniswap in the same way. If you looked at a financials ETF, there would be multiple companies that are competing as asset managers. There'll be Invesco and there'll be BlackRock, or competing as banks. There'll be JP Morgan and there'll be Citi. So it's these different channels or business services within the financial services industry. And then within each sliver, a couple of different assets will be competing to try to be better, right? Sushi Swap is a competitor to Uniswap, but they're both legitimate DeFi assets.
Much of the ecosystem is built on Ethereum, or the whole thing is really. To what extent is there a beta, if you will? To what extent is the ecosystem tied to the Ethereum trading price?
It's related in that it's built on Ethereum, but there's a big dispersion in returns. So they're highly correlated is the answer, but there's a massive dispersion of returns. So if you look at the returns of Uniswap over the last year, my guess it's something like 5x the returns of ETH. And ETH has been a fantastic asset. So it's kind of the way to, again, to go back to analogies, think of like an internet service provider like Comcast versus an app like Facebook, right? Facebook exists on the internet. You wouldn't be able to get it in your home if you didn't have Comcast. That's not quite a perfect analogy because it'd be more like owning the internet itself, but we can't do that. But that gets you in the ballpark. So ETH is an important part of the ecosystem. The more DeFi activity, the more value will be created in Ethereum because the more demand for action in the Ethereum blockchain. But it's not a one for one, right? It's more like that example of Facebook versus Comcast.
I mean, the correlation is very interesting because you guys are really the first ones to have popularized the idea of an index fund within crypto. But it seems like they do move. We haven't really tested it for a very long time, and there'll be different environments, but it seems like they do move pretty highly correlated. So, I think a lot of people say, well, there's, what are the chances that, Bitcoin crashes? Let's say, well, it's a non-zero chance. And even if you're very bullish, you got to say that there's, you have to protect yourself in some way. So it kind of gets back to my other question, like, are these like a higher beta Bitcoin, or because there's so much activity and, protocols being built and so much innovation happening, are they going to stand the test of time and they have that potato peeler aspect to them?
It's a great question and a challenging one. Look, when I think of the returns of different crypto assets, I think of two different drivers. On the one hand, you have industry risks, right? There are major movements to regulate crypto that are going to affect all crypto assets in the same way that major movements to regulate financial services will affect all banks and different services. But then there's also this secondary piece, which is product market fit of different assets and how fast they're achieving product market fit. And what you've seen over time is that in the initial phase, it was all basically beta of one because the industry level risks were vastly more important than the product specific risks. I think when you get to DeFi, you're going to see a lot more of that balance shift to the individual asset. So for example, decentralized exchanges have really found product market fit. When you talk to some of the largest crypto hedge funds in the space, they're now executing trades on decentralized exchanges instead of Coinbase because they're getting better executions. So it's found real product market fit. Other aspects of DeFi that are intellectually very engaging, like insurance on smart contracts, can be done through DeFi protocols. There are DeFi assets that do this, but that hasn't caught on yet in the same way that decentralized exchanges has. So I think over time, you're going to see lower correlations. But if we're being honest, if you look at the correlation of stocks in XLF, the large cap financial space, it's about 0.8 to 0.9. They're very highly correlated too. You're going to see something similar in DeFi. I think they'll be actually less correlated than that. They'll be like 0.6 to 1. But they're still going to be fairly highly correlated because that industry risk is still really important. And you can't overlook that and just focus on the product competition.
I mean, you mentioned the smart contracts and all that. I mean, to me, that's just the coolest thing. And the possibilities, I came up as a product developer. The possibilities of different things that you can create there, wills and just all sorts of stuff that you can really get creative with and that you never have to manage, that you can automate. It's so exciting. And tell me some of the cool stuff that's being done right now, using protocols.
Yeah, well, it's more than that. And then I'll get to some of the specifics, but then also compound innovations. To put it in the traditional financial services world, imagine if you could tap into JP Morgan's network of customers and its balance sheet to build an application on top of that without having to do a business development deal with JP Morgan to make that happen. In crypto, you can do that. You can offer insurance on a loan done through Aave through a decentralized format without talking to Aave. You can offer liquidity or instant collateral or arbitrage functions through Uniswap without ever working with the Uniswap team. So this idea of permissionless innovation is driving just enormously rapid innovation in this space. What are we seeing? And then to tie back to the potato peeler comment, which I think is a good one to think of, you're seeing a lot of innovation within existing protocols. So Uniswap is a great example. People think these protocols just get developed and then sit there. It's actually gone through a major evolution in how they provide liquidity that's made it 10 times more capital efficient to do so. And that was just pushed through, in the past few months and has accelerated its lead over its competitors and likely made it more of a potato peeler asset. But I think there are two general classes. One is automating things that are obvious and exist in traditional financial frameworks, which we talked about, exchanges, lending, et cetera. Some of the things I'm excited about are things you could never do before that you can't do in the traditional financial system because it's too slow. So a great example is settlement-free arbitrage. If you think about arbitrage, one of the biggest challenges is sort of the delays in settlement and how that slows down the space. Imagine if you could do atomic loans of one asset for another asset that settle instantaneously and able to apply that capability to arbitrage. You can actually conduct arbitrage in the DeFi space within one settlement block of an asset like Ether. You can trade one asset for another off of another and then settle both of those transactions at once. The ability to do these sorts of new things that you can't do in the traditional financial system, I think it's really exciting.
Yeah, no, it is. It's exciting. It's early. So there's still plenty of, obviously plenty of risks. So let's talk a little bit about stablecoins. It seems to me that Tether is a stick of dynamite waiting to explode. But the weird thing is that everybody knows it. I mean, I don't have, I'm a novice to I'm a beginner to this space. And, I heard this, multi-part podcast series talking like in detail about, how they went in, they found everything that Tether owns or doesn't own. And I mean, it seems like it's sure to blow up from what I can tell. How is it possible that like this is like a known thing and it still exists? And, what's the contagion risk? Well, you know what? Let's actually, if you don't mind, just for our listeners, what is this issue with Tether?
Okay. Tether was the first stablecoin. And Phil, if you want to think about how stablecoins should work, they should work like money market funds. You should give someone $1, they should deposit it in treasuries, and they should give you a digital representation of that dollar. And as a business owner, the value of providing that service is you get to arrogate the interest on the treasury investment while the other person gets this new, easy to move digital dollar, right? That's how stablecoins should work. That's how modern, well-regulated stablecoins like USDC do work. Tether was the first. And to contextualize something that I think is difficult for people outside the crypto industry to understand, in the early days of crypto, it was impossible to have a traditional banking relationship as a crypto-focused company. To make that real for you, Phil, Bitwise in its early stage was backed by some of the leading venture capital firms in the world, right? General Catalyst, Khosla Ventures, Kraft. I mean, it was an amazing list for a seed round. We couldn't get a bank account to make payroll. And we're not like an edgy, risky crypto company. We're an asset manager that happens to operate in the crypto space. But in order to get a bank account, we had to call in a favor from 2 of our angel investors to the only bank in America that would provide services to a crypto company, just so we could literally provide payroll services to our employees. It was really hard. So 3 years before that, when Tether got started and they were handling billions of dollars, there was no bank that would take their money. And so as a result, they started using shadowy payment processors in countries like Panama. And they actually lost, I think all indications are, like $1 billion of investor funds, right? It was a bad situation. They lied about the collateral. They said they were fully collateralized, but they weren't. There was a New York Attorney General investigation that sort of proved that they were only 70% collateralized. They should have blown up. It should have gone away. The world would be a better place if they went away. Instead, what happened, this is like a miracle story. Instead, what happened, the founders of Tether did effectively an equity offering on their core business, which was a crypto exchange, raised $1 billion and recollateralized Tether, at least they appear to, such that it was back to something close to 100% collateralized. Now, it still exists today, and it's gotten a lot bigger, and they're not very transparent about their reserves. And I wish it didn't exist. But it is important to realize like how we got here with this flawed instrument being in the center of crypto. It filled a real need of crypto. At the time, you couldn't do it the right way, right, with a money market-like fund. And so they did it the wrong way. And they managed through like a miracle of luck not to completely collapse. All right, contextualize that. Where does it go from here? I wish it would just go away and everyone would move to these more well-regulated, well-developed stable coins. And I think that will happen over time and the crypto market will be better off for it. But it has proven remarkably resilient. I don't know what to say about it. I don't think it's going to blow up because I do think it's under regulatory watch and it's a very valuable business. But I don't think the risk is zero. And I do wish I didn't have to wake up and think about it, Phil. It would make my life better.
The numbers I heard, and again, grain of salt because I'm not really expert in this, but from my understanding is about 70 billion invested, and there's some debate, but it could be as much as or as little as like 10% collateralized because a large portion of what they are supposedly collateralized with is commercial paper, but nobody in the commercial paper industry has ever sold any commercial paper to them, so even that is very suspect. I mean, let's say in a worst case scenario, let's say the $70 billion goes poof tomorrow and it's gone. What are the contagion effects to the rest of the industry?
That's great. That's a great question. There is some sort of pro-cyclical leverage built into the crypto industry and specifically into DeFi, where loans into one asset are built on another asset. And I think you could have a relatively significant collapse of that. And then there's also a fair amount of futures-based leverage in the crypto industry, which creates pro-cyclical downside risk. And so I think you could see something that looked like a flash crash. And one important thing that's different from crypto versus traditional financial services is that there's no one to like shut down the exchange, right? The closest you can get is like a DOS attack or a DOS effect, where the exchange just gets overwhelmed and therefore stops processing trades, which has happened. It actually happened at the start of the pandemic when crypto prices sort of flash crashed down to $3,000 Bitcoin. But there is a real risk of short-term contagion, pro-cyclical deleveraging, and a flash crash. On the other side of that, Phil, I think you'd have a tremendous bull market because people like you and me would feel more comfortable with a world where USDC is the primary stablecoin or other well-regulated stablecoins. But in the short term, it wouldn't be fun because this leverage and deleveraging aspect is a very real part of crypto. So yeah, short term, not fun. Long term, I think super bullish. For what it's worth, I think that's a story that's true about a lot of crypto. Right now, we're going through a period where US regulators are talking a lot about crypto. They're talking a lot about DeFi. And in the short term, that's been a negative on prices. That's part of the reason why prices are down since May. And over the next 6 months, it's unknown. There may be a lot of negative regulatory news. Long term, it's going to be positive. So short term negative, long term positive.
So how do you do your due diligence on these, on the protocols, on all the different, parts? I mean, how do you, ensure for your investors that what you're investing in doesn't have the same risk?
Oh, that's a great question. And I have one more thought on the potato peeler comment that I want to get to. Our index methodologies have a huge number of rules that screen out a large number of assets. So if you were to go to a naive crypto data website like CoinMarketCap or CoinGecko and look at even their large cap assets, their list of large cap assets, and compared it to our list of the top 10 assets, you would see that there are a large number of assets that are missing. In fact, you have to go down to asset, I think, 29 on coinmarketcap.com to get to the 10th asset that makes it into our large cap index. The things that we screen out assets that can't be held at a US regulated custodian because that gets a lot of assets that have risks. We screen out assets that only trade on one crypto exchange because crypto exchanges allowing trading is a positive signal. We screen out assets that we think are at risk of being deemed securities by federal securities regulators, like XRP is a good example. We screen out assets that are new, that haven't been on the market for a while. And this has a real impact. And people always come back to us and ask us, what about this asset? What about that asset? What about that asset? And the short answer is, if you can use these words together, Phil, we're a conservative crypto asset manager. So we want to screen out all of these risks. And there are a lot of risks in crypto. I would add DeFi, huge risks. I mean, there are major regulatory risks. I think the DeFi market is the most exciting corner of crypto with the most potential. And I think it's going to have the most volatility over the next 3 years.
So you had a front seat at the table with ETFs from before the tipping point or before the S-curve. Now they're, of course, ubiquitous. What is different about the ETF adoption curve from your early days of ETFs to what you're seeing now in crypto?
Crypto is faster. It's being adopted more quickly. It has further to go. It's disrupting a bigger industry than the ETF space. But some of the things are remarkably similar. The ETF industry doesn't like to talk about this much, Phil, but I know we have a fair amount. In the early days of ETFs, people didn't like them, right? The Financial Times called them weapons of mass destruction. I don't know if you remember when Neil Archard was hauled in front of Congress and grilled about whether ETFs were destroying American entrepreneurialism and killing the American dream. But I distinctly remember that. People think of ETFs today as like the mother's milk of investing, and they forget that they were this renegade bad boy that no one believed in, that were, less efficient, less liquid, had all these issues. And today we've transitioned to, where they're the centerpiece of investing and they're going to take all assets from the mutual fund industry. I see a lot of that similarity in crypto. Weapons of mass destruction, rat poison squared, congressional hearings, regulatory focus. But at the core of both of them is a technological breakthrough that makes things faster, more efficient. And there's a manifest destiny in the financial services world to move toward that future. And that's what turned ETFs from $100 million to $7 trillion. And it's what's, I think, going to make crypto a 10, 20, $30 trillion industry eventually.
When you talk about the regulatory focus, when you talk about, I mean, really in general, when you talk about the efficiencies that are being created in DeFi versus the traditional old pipes, there's no more glaring example than what you and others too, but what you've been through trying to launch a crypto ETF. You know, your firm filed, several years ago. You've submitted over 500 pages of original research. You've had 8 meetings, I read, with the SEC, probably more by now. A large number of industry participants, have reached out to advocate on behalf of a crypto ETF. There's probably not a lot you can say about the experience, but, what can you say?
It's been a long road, Phil. I was working on it today. I can add that. We continue to work on it. And of course, it's not just us. Other great firms, Van Eck's been at the forefront. Others have been cracking on it. What can I say about it? I will say this. The SEC is very engaged on the crypto ETF front. They've asked good questions. It's certainly true that when the first Bitcoin ETF was filed in 2013, I don't think the market was mature enough to accept an ETF. I now think it is. So they weren't wrong at that point. Ultimately, the reason a Bitcoin ETF is important is because the SEC has a high bar on approval. If they didn't have a high bar on approval, it wouldn't be as important. So part of what we all get angry about is that they have this high bar on approval and we haven't gotten over it. I do think we're going to get over it. And I think that will be an important milestone in the crypto space. I'll also add this to one more unrelated thought. One thing that happens a lot in crypto is people look at the price of Bitcoin and it's $40,000 and it's up so much. And I think that they've missed the boat. I think the ETF fact is an important fact to keep in mind, that it's still exceptionally early in this space. I mean, it's extraordinarily early in DeFi, right? I think most people recognize that. But even Bitcoin, it's still exceptionally early. Most people are on the sideline. Most institutions on the sideline. There's still regulatory issues. But, I think we'll get there. I'm still cracking at it, Phil. I'm going to get over the hump.
Well, I wish you success with that. I mean, for no other reason, it's really absurd that people can access crypto through the public markets, but through inferior vehicles. And, I think that's really a shame. I mean, the role of the SEC could be debated. And, I think they do a very good job. Our capital markets in the US are more efficient than, has ever been in the entire world. But, there's also a libertarian streak in me that says that two consulting adults, you want to sell me a Bitcoin ETF and I want to buy a Bitcoin ETF. I don't need, a government agency to tell us that we cannot transact that way. And instead, I got to go buy MicroStrategy. To me, it could be a little counterproductive. But, obviously, I don't want to, represent that on your behalf.
I appreciate that and feel some of the same sentiments. But we'll get there. We'll get there.
You will. And so I like to close with this question. Tell me an obstacle that you've had either in your personal life or your career that you've either found a way to work around or just persisted through.
Well, I hope that the Bitcoin ETF becomes that obstacle. And I can tell a great story about persisting through and the challenges therein. I was thinking a little bit about this question while you asked it. Two things that have been true in the ETF and the crypto land is that in the early days, people were just reflexively dismissive. People were reflexively dismissive of ETFs. They were particularly reflexively dismissive of bond ETFs. They're reflexively dismissive of crypto without thinking about what it means. The way I've gotten through that in the case of ETFs and the way I hope to get through, and maybe we're starting to do it in crypto, is just by repeating the sort of fundamental core facts of the case over and over and over again. You alone probably heard me give my ETFs 101 talk 15 times because I gave it at every conference in America for a period of 10 years. I'm now doing the same thing on crypto. I'm giving a crypto 101 talk at Morton Steakhouses, at 1,000-person conferences, at one-on-one advisor meetings, writing things for the CFA, saying the same thing persistently. And I hope that I'll have that same breakthrough that maybe I contributed to in some small way in ETF land.
Well, I think it is. I've certainly evolved my thinking on the topic, which I'm proud to say is not, to me, there's nothing more fun than changing your mind. It's an eye-opening. No, it is. Like, I know a lot of people don't like, I love that. I love, when I see someone who has, thought through something and I disagree with them, but they're like truly thought through and they're not threatened by my view and I'm not threatened by theirs, and you can exchange ideas. To me, that's a beautiful thing. And it's the same when I, come to change my mind, which I have on a lot of this topic. It's like a very enlightening experience. It's a fun thing to go through. So I enjoy that. And in no small part because, you and Teddy and the rest of the team and everything you guys talk about. Where can people learn more about investing with Bitwise?
Sure. Appreciate it. Come to bitwiseinvestments.com or follow me, Matt_Hougan, Hougan, on Twitter. Happy to chat with people.
All right. Well, thanks for coming on the show. Thank you to the audience for your time. And I'll have a new show in about a week.
Thanks, Phil.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.